Welcome friends to another episode of Arthashastra Talks. Arthashastra Talks is a small effort from Team Arthashastra for the benefit of our investors. Friends, today we have Chandraprakash Padiyar, a senior fund manager from Tata Asset Management Company. Welcome Chandraprakash.
Thank you so much, Rajan.
Chandraprakash Padiyar joined Tata AMC as a senior fund manager equities in September 2018. Chandraprakash previously worked with Alchemy Capital Management as a portfolio manager for the onshore long-only strategies. Chandraprakash, popularly known as CP, has over 21 years of experience in research and fund management. He began his career in equity research and analyst at UTI Mutual Fund and in time was designated fund manager overseas mutual fund schemes. Chandraprakash is an MBA Finance from Symbiosis Institute of Business Management and affiliated to University of Pune and has cleared all three levels of CFA program from CFA Institute, USA. Chandraprakash ji, let us start this conversation with have a brief overview on Tata. Tata in so many avenues today, in almost all the avenues, is doing great guns, whether it is Tata Motors or Tata TCS, everything is doing great guns. I think similarly, I think it has happened because of the change of management at the top maybe last 5 years. Similarly, some changes have happened at Tata AMC also. So what are these changes and how are those changes going to benefit our investors?
Well, thank you so much, Rajendra ji, for having me here, and Team Arthashastra for inviting us on this talk. So Tata Mutual Fund has a very good long history, and what we have done in the last 5 years or 4 years plus is that we have articulated the investment philosophy with which we stand for. In our investment team, what we have done is that basically investors have reposed their faith in us, have given us a lot of their wealth to manage for them, and in return of that, what they expect out of us is one, ethics, and Tata Group.
Known for that.
Known for ethics. And the other thing is that we are supposed to identify businesses or bet on management teams which can deliver high profit growth over a long period of time, and not only profit growth but free cash generation, balance sheet being strong, and over a period of time where valuations can get re-rated. So what we do in Tata Mutual Fund, where the investment philosophy that we articulated, let's say about 4-5 years back, was growth at reasonable price, where we are saying that we will focus on limited number of companies. We will be bottoms up in our approach in investing and identify companies where management teams can deliver sustainable, strong, steady 20% plus profit growth consistently over long periods of time. India being a growth economy, we have opportunities like this where you can identify companies which can grow at a fast pace. So we are blessed with that. So we have chosen certain niche for ourselves in Tata Mutual Fund, and we believe that this strategy works very well over a period. So what we do is that we buy businesses where the management is able to deliver strong, sustainable profit growth. Let's say in simple terms, doubling of profits every 4 years.
Wow,
that's something that we aim for. Not every time you get it, but most of the times if you get it right, then you have done a good job. But the second thing is you buy at a time when the market is ignoring those businesses. So if profit growth is high, generally it is said that if profit growth is sustainable and high, then and with cash flow, normally market will not give it cheap. Our thought is that we buy businesses at a time when market may be ignoring certain management teams or businesses for certain specific reasons in the near term. We look at long term.
So more of an opportunity.
I will buy today for the next 5-10 years for that compounding of wealth. And if I am early in buying, and from my time of buying, if the company can deliver and surprise the market on the upside on earnings consistently, then you have a chance of getting re-rating of valuations as well. So our philosophy of investing is that we look for both. One is profit growth, making money from profit growth, which is the value of the business growing because profits are growing, cash flows are growing, but also combination of profit growth and valuation re-rating over a period of time. So that's something I think in the last. You asked us what has changed, and this has changed, which is that the style or the way of identifying businesses and benefiting from re-rating of valuations. So over the last 4-5 years, though early days, 4-5 years is
Not a very long
history, but in this 4-5 year period, we have had more than 10, if not more, examples where the value of a company at the time of our buying and today would have gone up by more than 10.
Wow. 10 baggers.
Yeah, so multi-baggers, let's put it that way. So we've had experience of identifying companies early and holding with them. So for example, the funds that I manage, for example, the average churn is less than 0.2.
Wow.
So we don't churn, we are
Buying and holding.
buying and holding with high conviction, betting on management teams which can deliver consistently over a period of time. And that I think proof has given us very good results. Most of our schemes, as you would know, Rajendra ji, is it is either in top quartile or top 2 quartiles consistently now for a long period of time. So we are doing well as Tata Mutual Fund, and we hope that we continue to do job.
So just like other brothers of Tata's. Yeah, great. CPG, COVID crisis, ongoing Ukraine-Russia war, inflation all over the world, inflation in India. I think nothing seems to be affecting India today, and India's market is touching all-time high. So what are the attributes and how this is happening? And especially investors have these questions that are we at a stage where markets, is there a bubble or there is still steam left in Indian stock market?
So we are in a way we are actually standing out in the whole world today. See, for example, I'll give you a specific example. When I look at between 2009 and 2019, most of the world countries, which is US, Europe, Canada, Japan, China, were seeing real estate doing extremely well.
Okay.
And their real estate markets peaked sometime in 2020-21. And they had a consistent period of real estate cycle doing extremely well.
Okay.
On the other hand, we were a country where real estate was significantly weak for a fairly long period of time. In fact, if you all remember 2018, some of the NBFCs defaulted in India because of precisely the reason some builders defaulted on loans and IBC came in, and that's history, but it's the context with which you look at. For between 2008 and 2019-20, India was actually undergoing a transformation. We were consolidating as an economy. Nothing worked. It looked like that nothing worked. The government of India, I would give them credit a lot. The regulator, which is the RBI, and government of India together probably took care of many of those. For example, IBC was brought in, RERA was brought in, GST was brought in, and today UPI, today the payment ecosystem, account aggregator, many things came in all over the last 4-5 years, and because of that we were seeing consolidation of our economy. Profit growth in India, for example, in between 2008 and 2020 was low single digits CAGR.
Yes.
So when you have low single digit profit, then markets also don't do so well. So if you look at the history, we've not done so well between 8 and 19 or as a calendar year because profit growth was not there. Unlike that, the world was seeing very good growth. World was seeing good markets. So come today, our real estate cycle is picking up. Our banking sector cleanup has happened, so credit growth is picking up. Corporate debt is the lowest in a long time as a percentage of GDP. So that is now starting to pick up. Capex is now starting to pick up. Government revenues have shot up significantly because of GST now. So government is able to spend on Capex. Both state center are doing a good job, and they are more disciplined these days. And most importantly, see, banking sector is the heart of an economy. If and ultimately everything depends on money, cost of money, and money supply, and it creates sentiment, positive or negative sentiment. We are at a point where the cleanup of the banking sector is so strong. For example, the largest bank in the country, which is more than 100 years history, today you look at the balance sheet today and compare it with their 100-year history, it's the best today ever.
Wow.
The kind of provisioning coverage ratio where PSU banks are sitting on today, we have never seen this kind of balance sheet cleanup that has happened ever. Also, what is also happening is that look at the government balance sheet, which is the fiscal deficit. What they've done is everything that was off balance sheet for the government, whether it is FCI dues or railway dues or NHAI loans, everything is now part of the fiscal budget.
Wow.
There is nothing outside.
Okay.
So transparency has gone up significantly. Whatever data you look at, you can trust that data. And that is where I'm saying that there has been a sea change in the way we ourselves, the way we used to look at data points from the government. And so I would say that when you coming back to your question, between 8 and 20 we were in a period of consolidation, whereas the world was doing well. Today we are doing well and world is seeing a peaking or going down. So their real estate, for example, I started with real estate market in every large part of the world, where you look at any country, has peaked in 2020 and now has started seeing a fall. So it's actually started now. And at a time when interest rates are going higher and there is this war, and you rightly mentioned there's this food inflation happening, Germany seeing, or Europe in general, and Germany seeing energy issues. We have started hearing one new term, Europe plus one. So these are interesting times for India when we are picking up from a domestic demand perspective, and the environment is such. And I didn't mention China. Chinese real estate is going down, has started. So they are facing the same problem which India had between 13 to 18. So they are now starting to see that. But the other thing is, cost structure wise, there are many businesses in India which have become more competitive relative to China. And with the energy crisis in Europe, we are certainly competitive. Let's say in chemicals, when we meet companies in chemical industry today, every company tells us that they have order books, so many orders today from European companies, that it is up to them to execute and scale. Or so they are saying, you put up as much capacity as you can and I will take everything from you. So the environment is in favor of India in an extremely big way, and we have never seen, at least in my 22 years of experience in the country, such kind of environment we have never seen. So we are an oasis in the whole world in that sense.
Whole desert.
In the desert, and hopefully it will continue. I think it will continue. We're just at the beginning point.
Hopefully this is not the bubble. Means great. India seems to be racing ahead in the tech and new age businesses. What are your views on that?
So the interesting thing is that in the last 5-7 years, the number of unicorns which India has created, we are probably the second largest unicorn generating country in the world
after China.
After China, so it's a achievement that so which means that startups are doing a great job. There are some businesses more in the unlisted space which we look at. In fact, today there are companies which are looking at global scheme of things. Earlier, whenever we used to look at startups, they used to be more looking for trying to work on a platform to reach the customer better in India only. There are businesses today in the startup space, no more startup, they are now $1 billion plus market caps. But there are companies which are trying to gain market share across the world. So the beauty of, so things have changed. The vision of Indian promoters have certainly changed. So that's generally very
heartening
good.
To know.
Very good actually. The only thing about this is that because of this change in interest rate scenario in the world, and free money not so much available nowadays, and the sentiment also changing, incremental funding to startup ecosystem has dried down completely. Valuations are coming down quite and I would say to an extent there was this
Froth.
yeah,
little
froth, you
bit
can
of-
say. Little bit of froth was there. That is coming down quite materially. That has good implications for people like us, because if we can identify right businesses at the right price, then we can make good money. So I think things are normalizing a bit. But to answer your question, yeah, I think we get enthused by seeing the kind of business models that today Indian startup ecosystem is generating and building. It's amazing. And the other thing that I want to highlight on this, or in the same vein, is that with the government creating this UPI payment ecosystem and incrementally account aggregator ecosystem, and generally the whole payment and lending system being put together, there will be lot more innovation on the fintech side over the next 5 years. And this is something that anyways, from what we understand, there are countries other than India, so there are many countries in the world which are trying to take help from NPCI as an organization to build as a payment ecosystem in other countries in the world. So we are leaders in some places nowadays, which so it's a big change.
Great to hear that. On the other hand, if we see, there is a global inflation, and globally interest rates are going up drastically. So what is your view on, because this interest rates going up can impact every kind of an industry. So yesterday also RBI has increased the repo rate by 0.35%. So interest rates in India are also going up. Now that will impact Indian companies. So what are your views on that? And is it a good time for fixed income investors to take an opportunity? Are we reached a place where fixed income investors, especially senior citizens, can take the opportunity in the fixed income?
So there are two things that I want to highlight, and this is again related to the banking sector, and I'll come to your fixed income part later. When we speak to banks today, and when we generally do our dipstick surveys and analysis, what we realize is that one, retail borrowers who take loans for home loans or personal loans, everybody is bothered about their credit quality, the CIBIL score. So today when we meet a bank or a financial institution, they say that we don't lend below 700 CIBIL score. And the borrower knows from his experience that if I allow my CIBIL score to go below a particular level, I will not get incremental loans, or I will get it at a very high cost. So it makes sense for me to pay on time. So discipline has come. So retail borrower, which is why if you notice, the banking sector today has one of the lowest ever SMA, or let's say the 30-day, 90-day past due is one of the lowest ever actually. We are way below our pre-COVID for many banks and institutions. So that's, which means that one, we were anyways less leveraged as retail borrowers. But even on that, earlier there was some extent of default. This time around, at least maybe early days, but it looks like that discipline is very high. That's one part. Coming to your second part on the first part of the question is corporate loans. This is where there were issues in the past. The good thing is, so for example, just before this meeting, I met a chairman of one of the companies. I remember that company is in the railway, it supplies various things to railways. And when you look at their 15-year history in the market, they used to always have 1:1 debt equity. Today they are zero debt. And they are saying now incrementally, I have made up a mind that I will incrementally not have any loan on my book. I will work with zero debt. This sentiment or this language we hear across promoters. Company by company, when we meet, they say I am more focused on delivering return on capital employed, which is higher than cost of capital. It's a very different language that companies speak. So the aggregate impact is that today, when you look at aggregate corporate India, as per the data that I last saw, corporate debt to GDP is down below 48%. Now this last time, this 48, 2004, if I'm right with my numbers. So the last investment cycle that started in 2004, even prior to that, so debt to GDP, so which means that corporates are very low leverage. Most corporates, as we look at, have zero debt actually. And even if they have some debt, they are looking to reduce it to zero. So that habit has changed. The discipline has come in corporates as well.
So the impact
Which
of
is what,
interest
yeah.
rate
So the
going up.
interest rate impact, at least at this point in time, is not material. It's and so the other part of the question on retail borrowers is that we are used to 9.5% housing loan rate. We are still at around 8.5% housing loan rate. So even if rates, let's say, go up by another 50 basis point or 75 basis point, our house view or my fixed income team believes that from an interest rate outlook perspective, maybe the max that can happen is, if crude price don't spike, is around a 50 basis point at max. So we are almost there from an increase in interest rate, because our inflation outlook is likely to go down as per RBI projections as well. So from when I look at overall, I would say that doesn't bother us as of now. It's good on that count as well. From a fixed income investor perspective, I think yes. I think at least our fixed income team, I'm an equity person, but our fixed income team believes that these are good times to invest in fixed income funds for retail investors as well.
Take the advantage of this higher interest
And
rate.
should be there, which you advise anyway.
Yeah,
so some part should be there in fixed income at these rates of 10-year bond yield is 7.27 or something like that. At that rate, it makes sense to deploy some amount of capital in GSEC funds or SDLs or those kind of funds.
CPG, the current Indian story is completely based on consumption, Indian domestic consumption driven. But capex, though there are green shoots, it is yet to pick up in a substantial manner. So, do you see capex picking up in near future, or what could be the drivers for Indian economy?
That I would think it a bit differently. See, for example, in 2004 and 8, I remember very clearly, there were handful of names in corporate India which were doing very large capex in power plants, in road BOT.
Cement.
Cement was still a small part, but power, telecom and roads, these were three places where most of the promoters were investing between 2004 and 8, and the result, and everything was on leverage. Promoters at that time also didn't have enough equity of their own, so it was 70-30 debt equity, and most of the times even that 30% equity, now on hindsight we know, is some of those promoters didn't bring their own equity but took debt on that as well, and it hurt the banking sector very badly ultimately, because everything was on leverage. This time around, which is why I'm very optimistic this time, is that one, every company that I meet today in the listed space, at least, small ho, bada ho, medium size ho ya chota ho, everybody is expanding, because capacity utilizations have reached 80 or higher than 80%. Most companies in manufacturing, at least that I meet today, are talking of doubling their capacity and revenue and profitability over the next 3-4 years, because of the way the world is, China +1 and Europe +1 and all. And these are being funded on their own, which is 100% equity, very low debt. Whatever debt is being taken is all working capital loan, not long-term debt. So what we see today, so for example, when you meet capital goods companies, companies like Thermax, Siemens, ABB, the whole companies who manufacture products, which is ultimately used in factories for companies, we find everybody is full of their orders. This is the highest ever order book that all of these companies have. And now they are executing, and when you meet them, they say that there is no order. Like, for example, in the capital goods, whenever we meet these companies, they tell us that there is no order which is more than 400 crore in size.
Wow.
But there are plenty of orders below 400 crore size. There is this transformer company that I met recently. This is the largest in industrial transformer, and that company is, and I've been meeting them for many years, the promoter of that company, and in the past he always used to say that there are a handful of companies but large orders I have. Today he is saying that there are more than 100 companies looking to give me orders, but small, and he's very happy with it.
Yeah, it's a well spread.
So it's a big change, and my sense is that you will continue to see this. So in early stage of an economic revival, this is what happens. So you will see generally capacity is being built for manufacturing companies. You also have an environment where manufacturing is shifting from China very gradually, not materially, but let's say in auto ancillary, light engineering, pharmaceuticals, chemicals. These are places where we are seeing large shift to India. So you are seeing very big shift here. Plus, at the same time, government policies are motivating companies to shift towards in India. So you are seeing these. So at the initial stage of an economic cycle, you will always see small capex. The larger ones, which is steel, aluminum, power, I think are just at the corner there. When we meet, let's say all the steel companies, they have given orders, but because of this Ukraine Russia skirmish, most of them have stopped executing in a bigger manner, according to us. We believe a year down the line, 2 years down the line, this will also start.
Wow.
So the bigger ones will also start, especially on power. We are heading to a situation because of the last 2 years and the change in import duty on solar, for example, which the government did, and there is this PLI benefit that the government wanted all make in India for solar. Because of that, execution on solar came down quite materially in the last couple of years. Okay. For example, the government, the targets that they have, they want to set up 30,000 megawatt a year. What we are doing today is 11,000-12,000 megawatt. Okay. So we are falling short of power. My belief is that if we have to avoid seeing disruption on power demand and supply mismatch someday, you will see very large investment in solar power setup in the country. You need to
spike that up.
One more thing. Yesterday I heard, a couple of days में, I heard the power ministers articulating their plans on the transmission capex, which has been, so for example, in the last 3 years, if I remember correctly my numbers, aggregate capex over the last 3 years cumulative has been less than 30,000 crore on transmission, large T&D, what Power Grid and other companies do. The government is saying, or the minister said, that the plan is to spend 3 lakh crore and 30,000 crore a year now incrementally. Wow. So we are actually heading towards a situation where things will should logically, materially go higher. So you will see the larger part of the capex also happening. Today we are seeing small, which is a very good sign.
Great. So, especially in this, since we are talking about manufacturing, so PLI is a very popular scheme. So I just want you to explain to our investors in a simple language what is PLI and how does it benefit a manufacturer.
So just to give you a background on this, generally when we meet Indian companies, first of all, PLI is for sectors where India manufacturing was zero. Yeah. So government is saying that there are sectors, especially in electronics, high-end technology, solar, green hydrogen, even in auto ancillaries, specialty steel, there are sectors where our presence in Indian manufacturing was almost negligible in the past. So the government said that why can't we make it in India, because we will ultimately have scale over the next 5 years in all of these sectors. So when I compare costing of Indian because we were not present in this manufacturing in India, we were all importing. So since our scale was low, relative to a China, for example, cost of manufacturing was higher by around 8 to 12% in that band. So what the government is saying is that I will give you incentives as a percentage of sales between 4 to 6% every year, and it will be gradually coming down over a 5-year period. I'll start with a higher number, 6% let's say, different industries different number, and then gradually it will go down to 4 and 3%, and then it will go to 0. The government is saying in 5 years, their belief is that once you achieve scale, your cost of manufacturing automatically will go down. So you become
incentive linked to the manufacturing.
To manufacturing. So you will get incentive only to the extent you do sales. So on sales it is. So whatever sales you do, you get a percentage of
kind, encouraging them to do more sales, more manufacture, more.
Yes. And there are 14 sectors. The government is adding more of it. So only PLI incentive alone is something like $25 billion over the next 3-4 years.
I think India is among the top mobile manufacturers in the world today.
We are the second largest mobile manufacturer, second largest mobile exporter and manufacturer.
Exporter also.
Exporter also.
Great. So maybe PLI could have.
PLI will add now. So we will actually become the largest potentially.
Okay. How do you do your investments, and do you invest in mutual funds? This is for the benefit of
all of us, and almost 90% plus of my personal investment, and incrementally as well. In fact, now so SEBI, as per SEBI mandate, 20% of my salary gets deducted automatically and gets invested in my funds. So it's an SIP that I do with discipline. So so it's a great thing. And even otherwise, I've invested quite a bit of my personal wealth in my own funds as well.
Great.
So if I am managing something, then logically I should
Skin in the game.
skin in the game. Yes. So a large part of my wealth is invested in my own funds.
So
Majorly in equity. I am a risk taker, so I invest in equity mutual funds, and within that my own funds.
So one more question. Means suppose you have 100 rupees today and you have 10 years.
Yeah.
We are talking at when the markets are at 62,000. Where should an investor put the money if he has 10 years of horizon?
So on that, I will maybe try and simplify the way I see things. Is that ultimately why would we invest? We invest to beat inflation.
Yes.
So today the value of 100 rupees that I have should not go down because inflation is, let's say, 5% every year. If I don't make more than 5% in it, my value of that 100 rupees will keep coming down. That's the intention.
Real growth.
Right? So with that intention, equity one as an asset class is the best asset class to beat inflation.
Yes.
When I invest, and this is true for all investors, that they should do depending on their risk ability and the capability to withstand volatility. Different people will have different asset allocation. But I invest quite a bit, or let's say around 60-70% of my wealth in equity mutual funds, followed by fixed income and followed by keeping some cash as well. So I always prefer to keep, and that's my way of doing it.
Great habit, having good asset allocation.
At least 12 to 15 months of my salary as cash contingency, and balance I invest between equity and fixed income, and a large part now is SIP as well.
Great. So along with that, if we can also give our investors 3 mistakes which they should avoid in their wealth creation journey.
Actually, I would say these are maybe mistake is a too harsh a word. 3 learnings which I can maybe put it. But I must, before I do this, my observation, and you would agree with me, I'm sure, is that Indian investors today have learned the art of investing. Look at the way SIP, STP is happening in mutual fund industry today. I think it's amazing actually, and it's continuing in spite of let's say last 1 year market returns are not so great, 5-6%, 8%, and still investors are keeping the faith and investing. So it's SIP numbers are going up. So I think Indian investors have learned. But even then, I would say my learnings is that look at long term. Generally, the only problem in long term is that maybe it is we are to be blamed to an extent. When we talk long term, nobody thinks of more than 3 to 5 years. But long term is actually
10 years plus.
Yeah, 20 years. The longer, the better. So look at long term. That's one thing about investing. Don't ever, but you should certainly review and look at where you are invested. Every 1 year, every 6 months, you should review. But doesn't mean that you change your long term orientation. That's one thing. Secondly, I think return expectation should be normal. I think where people tend to make some mistake is that they end up chasing high returns and thereby take a lot of risk. If you aim for, and I think the normal return range for any investor should be 10 to 15%. If you aim for that band of returns, 10 to 15%, I think you will not be disappointed. And lastly, I think my own sense is that you should, and now that is up to different age group, different ability to take risk. Again, those are disclaimers. But my sense is that do look at within equity asset class, a larger part of your allocation should be in diversified funds. Either flexi cap, large and mid cap, diversified funds. Don't try to take too much risk in sector calls, thematic funds. Take some allocation, but not a material number. Because that's where mistakes tend to happen. If you take diversified funds, you are set.
More than set.
Yeah.
Thank you, CP. It was very nice, and thank you very much for sparing your valuable time. Thank you very much.
Thank you so much for having me.